Hey, good afternoon, everybody. I'm Mike Fielding at the law firm of Husch, Blackwell, and joining with me today are Tom Donaldson and Brent Sammons. We are here today to talk about navigating loans and loan renewals in the food systems space. I have some housekeeping items I need to read right now. Also, while this gives a moment for anybody who's late joining on. First off, at the bottom of your audience console, there are multiple application icons for your use during the program today. If you have any questions during the webcast, you can submit them via the question box. We will try to answer all questions during the webcast, but if we need to do a fuller, more detailed explanation, we may need to follow up with you afterwards on that, follow up via email. A PDF of the presentation is available today in the program materials folder. For those of you who need continuing education hours, the program has been approved for legal education and HR hours. For live attendees, you will report your hours by clicking on the CEU icon at the bottom of the screen. And then a certificate of attendance, including the numbers, will be emailed to you tomorrow, along with the recording of the webcast for watching and sharing. And then toward the end of the program, we're going to have a short survey. We'd really appreciate it if you could take 10, 15, 30 seconds, quickly fill it out. We really value the feedback that you send to us. We really look at that and then try to come up with future programs that, frankly, are beneficial and helpful for you. So that's it for the housekeeping items. I want to just do a quick introduction. Again, I'm Mike Fielding. I'm a partner here at Husch Blackwell in the food systems group. I'm the head of the ag finance group. And joining with me are Tom Donaldson and Brent Sammons. We were joking earlier that, all three of us have been practicing more than 20 years. And, we think, have we crossed the Rubicon of old age? Maybe so. I think I have them both beat because my oldest daughter and her husband, they're expecting their first child June 30th. So sometime in the next few weeks, you'll call me Grandpa, right? And then maybe that's the official crossing of the Rubicon into old age. Anyway, we'll see about that. What's unique about today is kind of the team we have here presenting. Just really quick, Tom has done a lot of lender work throughout his career. He's extremely experienced with it. He really understands loans from the lender's perspective. Brent, on the other hand, has done quite a bit of work from the perspective of borrowers, and he has a lot of insight and knowledge as well. And then you say, why on earth would we want me? And the answer is I do insolvency. And so when the loan craps out and everything's going bad, I see things that sometimes aren't maybe as quite as, high on the radar when you're doing a deal, but later on can actually have a really big deal. And so what we're trying to do here is bring kind of a well-rounded team when we're talking about renewing your loan so that you're getting all three perspectives, because we really want to try to make this as valuable as possible for you. All right, so enough about that. Let's talk really quick. You can see the agenda here today. I'm going to talk on current conditions, different options, the process of doing it, your A game, what you need to do to make the best of the situation, and then closing considerations when we do loans. So without further ado, Brent, tell us about current conditions.
All right, thanks, Mike. So the situation that we are in today is one of uncertainty, right? There's a war in Ukraine. I'm sure everybody saw in the news yesterday that one of the major dams, was either burst or was blown up by someone, and it is flooding large segments of Ukraine. That is going to certainly have an impact on their continued ability to grow and send food into the world. They are one of the largest producers of food on the planet, along with the United States, Canada, Russia, Brazil, Argentina, Australia. But because of the impact of the war and the sanctions on Russia, it's taking out, I think, two large producers. The fact that natural gas is not being really available from Russia for the Europeans is impacting their situation. As everyone is aware, over the last several years, we've had supply chain issues, particularly shipping related. There have been ship seizures by Iran, I think 3 of them. There is something brewing on the West Coast, which most people, I think, are not yet aware of, and that is a labor dispute between the labor union and the owners of all of the ports on the West Coast of the United States. They are in negotiations for a new contract and apparently have reached an impasse because the port owners have refused to, or demanding a 3-year wage freeze from the union. And the union is refusing to do that because the shipping companies have made more over the last couple of years than they had for the prior 10 years combined. So normally what you would expect there is that you would ship things through the Panama Canal to the Gulf Coast and the East Coast. But Panama is currently experiencing a drought, and they are restricting shipments through the Panama Canal because the Panama Canal is above sea level and is fed with a large lake in Panama, and the level of the lake is dropping. So they are restricting shipment through the Panama Canal, which leaves go the long way around South America or the very long way around through the Suez Canal if you're trying to get to the East Coast. All of which means goods from Asia to the United States are going to be impacted in some way. Balanced against that, we have the Federal Reserve raising interest rates. People seem to be, or at least previously seemed to be, of the mind that the Federal Reserve was going to pause at its current rates. But the GDP numbers and employment numbers continue to come in at, good numbers. And the talking from the Federal Reserve is that they are trying to drive unemployment up, essentially to curb inflation, which may not work, or certainly isn't impacting the employment situation currently. And with, as I just mentioned, some potential future supply chain issues going to be pushing and potentially continuing to push inflation up, we may see additional interest rate hikes from the Federal Reserve. That is because I'm told by our economists here that the core inflation rate, which is what the Fed focuses on, is still at roughly 5.5%. The top line number that you see is heavily impacted by food and energy prices, but the core inflation, which is what the Federal Reserve focuses on, is still relatively high. It's not dropping down, which leads us to, are they going to drive us into a recession? I don't know. Nobody on this call knows the answer to that one, but it certainly seems like it's a possibility, and the Federal Reserve seems like they might be leaning towards attempting to do that, or trying to get us as close to recession as possible without actually doing that. So another thing that goes into this is the tightening of credit standards. There are people out there that are monitoring this, and credit standards for loans of all kinds are being tightened, even unsecured debt like credit cards. Even credit cards are being tightened in terms of who are being issued credit cards and what their credit limits are. So the result of all of this, inflation and increase in interest rates, is that the cost for all inputs from the bottom of the food systems chain, like from the production of grains and livestock all the way up the chain, is being pushed higher and higher. Which results in ultimately margin compression all up and down the chain. Because of the uncertainty and volatility of prices, that puts you in a position where if you're able to have loans in place, particularly revolving lines of credit, you can take advantage of like downturns in prices to the extent that they occur, and lock those purchases in place at a lower rate. I know that for the kind of like growers of grain are having to lock in their purchases for fertilizer and that type of stuff even earlier than they used to in the past. So having that available cash is helpful. Obviously, it's important if you are higher up the chain where you're a manufacturer. Allows you flexibility and gives you the ability to make opportunistic acquisitions in the next couple of years, because it's likely that they will present themselves. If as the interest rate environment stays the same or goes up, you're going to inevitably have some sort of business failures and some entities that enter into either debt restructurings and sales or bankruptcies, and then you can purchase the assets out of bankruptcy. So I will turn it over to Tom.
Actually, I think we're going to me.
Oh, I'm sorry, Mike.
Well, I need to make one quick comment about Brent's earlier point on the, we'll just jump back here on the slide. The rising interest rates and tightening of credit standards. I need to say just parenthetically, you know, I'm in the insolvency world, and so I get every single day, I get from around the country a listing of all the new bankruptcy filings that have happened. And I will candidly tell you that I have been really surprised at the big uptick in commercial filings in particular. There was a report that came out, I don't know, it was last week. I think it was for the month of May, year over year. Commercial filings were up like 110%, so more than double. Now, people will say, well, last year commercial filings were really low, and that is definitely true. But what I'm seeing just on kind of when you look across the country, what's happening, at least initially, is you are having a lot of companies that the rates are just killing them, and they are, especially they're filing down in Houston, a lot of them, these very big mega companies, and redoing a lot of their major debt that they have. So my point here with this is the stress is definitely out there. People are beginning to feel it. I imagine that some of you watching our webinar today are beginning to feel the stress of rising rates, or, you know, your loan's going to be coming up for renewal, and the lenders, you know, they want to take advantage of the rising rates, and you're trying to say, how am I going to deal with it? So obviously that was the point of, that's part of what we're here to address. So when you talk about options, we'll just cover this really quickly. I think it's important. There's really, you could say a continuum, and a continuum is maybe not the best word, but there are a lot of different options of entities that you can go to get your financing. You have your, you know, your traditional sources, which are going to be your banks. That can be a community bank, or, you know, state chartered bank or a national association. Credit unions can do some sort of, they can do some amount of commercial loans as well, but these are just your regulated lenders. Obviously, if you are in the food sector specifically, there's always farm credit, which is huge, which is out there. And then you get into some of these, what I'll call semi-regulated companies, companies that the insurance companies in particular, or pension funds. They want to go out there. They want to do like ag-related loans. MetLife, I know, is an example of one that does loans, you know, because they viewed farmland as a good investment for mortgages. You know, they get it, but they'll do it with a healthy loan-to-value ratio. Then you step into kind of, you could say that's the upper tier. Upper tier may not be the right word. More traditional tier would be kind of on the top part of the screen. And then the second tier, and I only say second tier in the sense of you get into these non-regulated lenders, the private equity, the private companies. Some people pejoratively will call them hard money lenders. And there can be some truth to that. There's a big spectrum there in the non-regulated lenders. Typically, what you find with the non-regulated lenders is it's easier to get the loan. But the terms can be very onerous, and there can be big upfront fees, big upfront costs, higher interest rates, certainly. And frankly, if you default, you know, sometimes you have some of these companies with a loan-to-own strategy. Others are in there just to, you know, try to make a quick profit. And so they definitely have a place in the world. They definitely serve a segment in the market, but if you're going to be entering into a loan with one of these folks, you need to, you know, really read your loan documents and know what sort of situation you're getting into. The final one, friends and family, right? Depends on how rich your friends and family are, right? But they are always a source, a way to try to get some additional financing as well. And I think the one point here is given these tightening credit conditions that we're seeing, the key point here is when you're going out there you might have had a long-standing relationship with your bank or whatever, and that's good. It's frankly, you often probably want to keep it, but it never hurts to start shopping around a little bit as well. And it may be that you want to stay with like regulated banks, but you can start seeing, are they going to compete a little bit on rates, on terms, that sort of thing. So the other point here are the different types of loans that you can get. Obviously, I don't need to belabor this one. There are all sorts. You have your term loans. You're going to get a revolver with your line of credit, asset-based. If you're a small business, you have the SBA as availability there. Factoring is always a unique way to approach to get some cash coming in the door. And then obviously vendor financing or business credit card. So when you are considering the loan, there's different options, right? You may have been in like a traditional term loan. Maybe you had a small revolver to help with some cash flow needs. But then the question is, well, could we maybe restructure it, go somewhere else? Can you get a large business credit card? But what are the terms? What's going to accompany that? And it's, I don't know if I want to use the word symphony, right? But my point here is that when you're trying to look at, especially when you're refinancing, you've had an orchestra, so to speak, right? You maybe have had these different components, and that's been playing the music. Orchestra's too much, right? Too many instruments. You've had a band, right? And you've been getting your financing from maybe a few different sources. And the question is, do you want to keep that same composition of the band, or do you want to mix it up and bring in potentially some different players? So,
and kind of like you're pointing out with the sources of debt financing, the type of loans vary in terms of the requirements that you have and the cost of the money.
Yeah, absolutely. It makes a big difference. Absolutely. So, all right, Tom, tell us about the process.
Sure. Thanks, Mike. So going to start with the beginning, which is before you get into, skip the slide there. Before you even contact your existing lender for a renewal, or you're looking at a refinancing or getting into a new loan relationship, some steps you can think about before you begin. First is just to clean up your financial records, and the most obvious one there, right, is your financial statement. So if you're still working on your 2022 audit, I'm sure a lot of companies are. There are exceptions to that need to be dealt with. Perhaps getting that cleaned up if you've got the time before your renewal comes up. Other things to think about: what other debt is on the balance sheet? What other debt is out there that a new lender might be concerned about, or at least want to know about, right? And that could be things like investor or shareholder loans. That, by the way, is another source of debt financing. Friends and family, but there also might be shareholders or investors, equity owners investing in the business. Probably okay. Maybe it needs to be subordinated by according to the terms of the new loan or the new lender. You could have equipment financing, could have real estate loans, and all this stuff may be okay to stay on, but it needs to be disclosed and considered as part of a renewal or a new loan. UCC filing. So I encountered this one recently. It was a business that was doing a new loan, and we ran searches. The new lender ran searches on the business and found that there were a couple of suppliers who had made UCC filings against the business, and those are, I think most of public records that show that a party. A secured party has a lien or security interest on the assets of the business. Questionable whether those suppliers were even allowed to make those filings, but it caused an issue, because the lender didn't want to close with those filings in place, and that took some lead time to deal with. Another thing to think about is just, is there any litigation? Pending litigation, threatened litigation anything ongoing that that you just need to get your arms around and make sure you're in a position to explain.
So Tom, I have a question for you. So what happens if a borrower doesn't do this cleaning up, right? You've identified several different aspects. And what if they're like, I'm too busy or whatever? How's that impact the lender from when somebody's coming in with a not so stellar financial records or some of these other issues?
Sure. Yeah. The biggest issue is, and I suppose the best case scenario is it causes delays in the closing process. And sometimes if you start early enough, it's okay to have some delays. But if you start late, and particularly on a refinancing where there's an existing lender that's ready to get out, there may be some default interest and some penalties associated with not paying that loan on time. So again, best case scenario is delays. Of course, the worst case would be the transaction doesn't move forward, and the company needs to scramble a little bit, look for other options.
Yeah, but Tom, you kind of alluded to it, but the delay can actually cost you money, because if you have another loan that you're refinancing and you get past the maturity date, they will sock you with default interest.
Yes, absolutely. Especially lenders that are ready to move on are not afraid to go ahead and
if it's a new lender, if you're replacing the lender, that in particular is a risk. If it's just refinanced with the same lender, it's not as big of a deal.
That's right. Yeah, I agree with that.
But some of those default interests, sometimes you'll have provisions in there that, they have kind of this hidden language, which is, if you're late on a payment, we're going to charge you 10% or whatever, right? And if it's your monthly payment, it stings a little bit. But what people don't realize is when that term loan comes due, now you're getting hit with like 10 or 15% on the full balance. So it can have a big impact to your bottom line.
Yeah, I mean, that's one of the things you try to negotiate out when you're doing the loan. Well, we're going to get to that. But yes, if it's there, that's a problem.
Yep, absolutely. Other part of just making sure you're prepared. Businesses are cyclical, right? And the food industry is certainly has that feature. And so be prepared to describe business cycles, the ups and downs of the business. Have there been any recent capital investments or acquisitions or any major extraordinary events that affect the balance sheets that need to be explained? There's usually good explanations for these things, but just be prepared to walk through with any potential new lender or existing lender those changes. And of course, the goal for every lender is to get repaid plus interest. I guess I would point out that the lending business, like any other, is competitive. It's very competitive, and if you have a good business, you're probably getting a lot of suitors, and lenders want your business. So, keep in mind that they're also looking to close the loan, get repaid, but also maintain a good relationship, and offer other products, including treasury management products, credit cards, escrow, those types of things. So as far as your lender relationships, Mike walked through the different types of lenders that are out there. You can do this yourself. That's free, right? Or pretty much free. You can get referrals, hopefully, and just through business contacts. If you get a broker involved, that may be useful. They might be able to get a good deal for you. Just make sure that you understand the fee structure and how the brokers are going to get paid. And in addition to that, you'll want to make sure that the confidentiality of your financial statements, records, that's protected and continues to be protected. And so you want to make sure that you have an understanding who that broker is reaching out to and what kind of information they're sharing, and that they're obligated to maintain the confidentiality of those records.
Your attorney and your accountants can help you on that too, because if they're operating in this space, they know who's operating in the space as well, and they can also give you, like, these people are easy to deal with, these people are difficult.
That's right. Yeah. We've all of us have done a lot of transactions, and we've seen we've seen enough players in the market that we might have some real life experience that we could share. Different lenders have different types of risk, right? So this could come in different forms, but consider loan to value ratios or borrowing base ratios. There's different levels of sort of conservative approach on how those things are valued, and so some lenders might give you a low loan to value ratio, like 50% or something like that, and so consider different types of lenders and risk. Also guarantees. If you have a business that's smaller, it might be a requirement of personal guarantees. Lenders approach guarantees differently, and so consider the guarantee requirement and whether the owners of the business would be willing to do that. If they are, is there an opportunity to limit those guarantees? In other words, have them be limited to a dollar amount or a percentage of the loan instead of the entire loan. That's quite often a point that can be negotiated.
Hey, Tom, let me interject one quick point on what you're saying there. Just going back a teeny bit on the covenants, I will just tell folks from a kind of an insolvency perspective, one thing, and again, this is a little bit anecdotal, but in the last, 2 to 3 years, I have definitely, it seems that lenders are looking more, they're looking harder at the financial covenants when they think there has been a default. And so one of the potential traps here for a borrower is you may be humming along, you might be current on all your payments, but if you've ignored essentially the fine print in those financial covenants, the lender may still declare a default and accelerate the loan. And that can come as a huge surprise to a business where you think everything's hunky-dory fine and suddenly you're in default. And so I just want to stress that one key point of when you're negotiating those financial covenants, I think especially where we're looking like we're going to be heading into a recession, there's a lot of storm clouds that we might be going that way. Those covenants are going to be really critical as folks are, I think, negotiating it because of the ramifications 2-3 years down the road from now.
Well, that goes to your comparison when you're shopping for a lender, right? Because you might get, when you shop to different lenders, one of them might give you a 5% rate and say, okay, but I want a personal guarantee and I got all these financial covenants that you got to hit. And the other one says, okay, but I'm gonna give you 6.5% rate, no personal guarantee, and super easy financial covenants or no financial covenants.
Right.
So you need to choose between those, but there's a clear trade-off that you're making, and that's usually the way it works. If you press down on the balloon somewhere, it pops up somewhere else.
Right. Well, and Mike, your last point, regarding financial covenants and covenant defaults, that's where this relationships matter. And the last point in this slide here, if something goes wrong, the best lenders are the ones that understand the business, understand why there is kind of a blip in the financial statements, or why this quarterly covenant was missed. Usually there's an explanation for that. Usually it's a good explanation. So relationships are important. So I think Mike alluded to this earlier. True lender versus loan to own lender. One thing that to be concerned with are, this is usually lenders in the less regulated space, and the private lenders may be out there looking to make a loan and find reasons for default, so they can end up in a position where they own the assets. And this just goes back to doing your research, getting referrals, get talking to your attorneys, your accountants, as many folks as you can, so you don't end up with a loan-to-own lender situation. So Fargo is one of my favorite movies. There's also a TV series. I think there are 4 or 5 seasons out at this point. Season 3 had a character called V.M. Varga, and he was a good example of a loan-to-own lender. So I don't know if that resonates with anyone, but Fargo is a great movie and series. Highly recommend it. All right, moving on. So say you're at the commitment letter stage, and we've got a whole number of things listed on here that for you to think about and consider. We'll hit on all of these fairly quickly, but as far as the most bang for your buck, at least in my opinion, Mike already mentioned financial covenants. Those are critical. Lenders track these, and quite often they're quarterly. Sometimes monthly, sometimes annually. But these are tracked, and as much as you can, the definitions are important as well. Try to model these and project these and make sure that they're realistic and achievable, at least based on everything that we know. So, and make sure there's a cushion there. You don't, if your debt service coverage ratio is 1.2 to 1 and all your modeling shows, 1.22 to 1, maybe that's an indication that's a little bit too tight, and you need to roll it down to 1.1. So financial covenants, and then related to that are the ongoing reporting requirements. Again, these are tracked. You will hear from your lender if you don't deliver your quarterly financial statement or budget or whatever is required. Make sure these are achievable. And if you don't do an audit, if you have reviewed financial statements, you all know there's difference there, a big difference in cost. So you'll want to make sure that that's covered.
Hey,
Aside
Tom,
from those, yeah.
Let me interject because, again, from the insolvency standpoint, one of the things, like when lenders come to me, they have a loan that's in default or that's teetering on the edge. And I will tell you that one of the very, very consistent themes that I hear from special asset officers is that the borrower has not been giving timely reporting or complete reporting or anything like that. And so I think to Tom's point earlier, which was relationships really matter. The question is, how do you nurture a relationship? And think about it with your spouse, right? You nurture a good relationship with your spouse through communication. And it's the same with your lender. If you need to be giving the financials timely, accurate, and especially if you're thinking that, oh, we're going to be having to refinance, maybe my business has deteriorated a little bit, and I know things are a little bit tough because we're heading into a tough economic environment. A key question you need to be saying to yourself is, what am I doing right now to nurture that relationship? Because if you're not being consistent on these financial statements or other reporting, you are, whether you want to or not, you're beginning to create distrust with the lender, which when it comes time to do the refinancing, they're going to be looking at you a bit more skeptically. So it's all very interrelated.
Yeah, I mean, the lending relationship is fundamentally is based on trust, right? Because you can have all the legal rights in the world, but if I'm in the lender's shoes, if I have all the rights that I could ever possibly want, but I don't trust the borrower, I'm not going to make the loan.
Yeah.
Right. So it's fundamentally a trust relationship. And if you are violating the trust or trying to hide things, it's just never going to work out well for you as the borrower.
Most CFOs know several weeks in advance whether or not they're going to hit a financial covenant. And I know lenders appreciate, they would rather know that in advance too and have a dialogue about it so that the parties can come up with a plan, as opposed to waiting for the default to happen, disclosing it in the in the financial statements, and then sort of asking for forgiveness after the fact. So it's something to think about. The other bullet on here, I just want to highlight our negative covenants. Why negative covenants? Because affirmative covenants are typically things that a business is going to do anyway, right? Most businesses plan on paying their taxes and complying with the law, things like that. Reporting, financial reporting, that's the one affirmative covenant I'd highlight. However, on the negative covenant side, these are quite often items that can have an effect on the business and the owners of the business. So consider distributions as an example. A lot of loan agreements prohibit distributions to the owners, dividends, distributions, or maybe they allow them, but only for tax purposes. Is the business doing well enough so that it can take distributions? Then that's something that you should look at and make sure that the agreement allows for. Other examples would just be like other types of debt. Perhaps there's a restriction on doing acquisitions. Mike mentioned earlier, and Brent, there may be opportunities for acquisitions out there. So perhaps you want some permitted acquisition language in there so that you can, you have that flexibility. Number of other things on here, like I said, the fees are important. Prepayment, that's something to look out for, particularly with fixed rate loans, making sure that's reasonable. And I touched on guarantees earlier. Some businesses, smaller businesses, there might be a guarantee requirement. Moving on to A-game negotiations. So this is really, we're talking about the loan documents themselves. Now we touched on what we're going to do to prepare before contacting the lender, and then discussed a little bit at the term sheet stage. And now we're on to, you actually have a set of loan documents. Hopefully you're working with an attorney. And these are some items that you can think about when negotiating these. Just one thing to quickly point out, particularly with real estate loans, in this first bullet, real estate loans are great in the sense that quite often they have longer maturities, and you can get a lower rate. But there are some upfront costs to those. Any of you who've dealt with real estate collateral as collateral know this. There's title insurance costs, potentially survey, environmental, zoning letters, and a number of those are not only costly, but require a lot of lead time and can delay the process. So consider that in real estate loans. We were just talking about legal opinions, the three of us right before we jumped on here. Legal opinions, I've been on sort of both sides of this argument. There might be scenarios where the lender would not require one, or if they are requiring one, it may be so expensive compared to the relative value that you're getting or that they're getting. And so that might be something that you could look at potentially getting waived. We already talked at length about financial covenants. Again, these are tracked, these are reviewed. You will hear from your lender if one of these has been breached. So consider the financial covenants and make sure they're achievable. If there's a reason why one's going to be breached, get in touch with your lender. All right. Other points in negotiating the loan. So on this side, I guess I want to hit on a couple of things. First is my approach has always been to try to get the most bang for my buck. Loan documents are long. I've seen loan and credit agreements at excess of 200 pages, and that's just the primary document. You've got a number of ancillary documents. You'll never close the loan if every single point is being negotiated in there. So try not to get bogged down on the details, focus on what really matters. Quick comment about representations and warranties. So these are, of course, statements that are made in your loan documents, statements made by the borrower representing to the lender that these items are true. Typically, they're given as of the date of the loan agreement, but consider revolving lines of credit and renewals. Those are, basically recertified. The language in the revolving line of credit will say something to the effect that every time a new advance is requested, the borrower is recertifying the accuracy of those representations and warranties. So
sometimes in your quarterly reports, you have to do that too.
Right. Yep. That's right. Yep. And those reports would also have statements that, that there's no default or no event of default. So make sure that if those certifications need to be made, that they're accurate and can be made. And do they need to be updated? So most credit agreements have schedules, and they would list things like pending litigation matters, indebtedness, liens, and security interests, that sort of thing. It may be that when you go to renewal, and you'll see a statement in your renewal documents that all the representations and warranties are true. Has anything changed? Consider whether anything has changed, and don't just skip over that.
Tom, let me interject another point. One of the things when a lender is looking at a loan and whether to declare a default, the first thing you look at is, has there been a payment default? Then you probably next would go to loan covenants. Is there a default there? Or is like the collateral really diminished in value? But then the next one is the reps and warranties. And if there has been anything that was false or, it was inaccurate when they made the rep and warranty, that can be a ground for a default of the entire loan. And so I can't stress enough, you don't just want to gloss over that and say, yeah, well, we're fine, we get away with it. The problem is because when things get tight, no, you won't get away with it. That actually may be one of the enumerated breaches of the agreement that you'll be running into. And on a related note, if you are a guarantor, maybe you're the president of a company and you've had to sign a personal guarantee, let's say you have a small business, and then you are personally making some reps and warranties, and then your company goes to bankruptcy, and then they sue you and you have to file your own personal bankruptcy. A lender may come after you saying you provided me with false financial statements, and they may try to really ding you in the bankruptcy. So my point here is, don't just gloss this over like, we'll just ignore this, it's no big deal. It can really come back and bite you if you're not careful. That's my main point.
And this is why we have Mike here to kind of bring in the element of scary for us transactional guys. But yeah, absolutely. And this last point here is it's usually a collaborative process. Both parties want to close the loan. I do a lot of work for lenders. They give me a loan to work on. It's not because they don't want to close the loan or they want to find a way to not make the loan. They want to close the loan. And of course, the borrower wants to close the loan. And so, quite often, this is and it should be a collaborative process. I'll bore you with one last movie reference. I used to give a similar presentation to law students teaching a class at Washington University, and I always put up this slide of I think it was a 1991 movie called Point Break, and it's Keanu Reeves and maybe Patrick Swayze doing a free fall or a parachute drop or something, and they're clasping hands. And this shows my age because none of the law students I show that to know what movie that's from. But that's the idea, work on it together, close the loan.
Tom, most of them weren't born at that time. We're dating ourselves.
I will. I'll turn it back over to Brent.
Great, thanks, Tom. So now we're finishing up negotiating or the loan documents. What are we trying to do to close? Now, in reality, these things are going to happen while you're negotiating the loan documents, right? Because your attorneys for the lenders and the borrowers have gone through this process before, and they know the things that need to happen to get to the closing. So usually pretty early on, lenders counsel will circulate a closing checklist and say, okay, this is the type of loan we're doing. We know what kind of security we're getting. Is real estate involved? If real estate is involved, it's a different animal, right? There's a whole set of things that are going on if you have real estate as part of the collateral package, as opposed to if there is no real estate as part of the collateral package. And that is one of the longest lead items. Has been, in my experience, it's always one of the longest lead items is if you have real estate as part of the deal. If there's no real estate, you can actually do a loan pretty quickly. As long as you don't have any other kind of weird third-party consents, like if you're taking out some sort of liens on like personal, like vehicles, or if you have to have some sort of weird like landlord consent or something like that, or if you have to get a deposit account control agreement with a different bank. Sometimes those things can take time, or to get the payoff letter as referenced here. Usually you can get a payoff letter within a few days. But if you have real estate involved, probably looking at a month or more, depending on how many parcels or how many issues that arise with it. It can be several months to get from beginning to end. And when I say beginning, I mean where the lawyers really start kind of getting involved, like in earnest. That's not, the beginning is not, start negotiating the term sheet. So those are if you have real estate, just know you're probably in for a longer haul before you're going to get any money as the borrower. But let's assume that we've gone through that process. Now we've closed the loan, you've gotten the money, yay, party time, except you got to pay it back. So that's maybe not so exciting. But now you need to focus on, I've got to comply with the terms, which we've already kind of touched on. But you have regular reporting, which is usually quarterly, as Tom said, sometimes monthly or annually. You've got your payments that you have to make, which again are often quarterly, but sometimes monthly. And you want to make sure that you're in communication with your lender. One of the things that I recommend to clients that are borrowers here is that they have us put together some sort of memo or checklist for them in order to know what they need to do. Because the fact of the matter is you probably have like 5 to 10 documents that you have signed, and they have obligations sprinkled throughout them in different places in the documents and in different documents. And so it's very helpful to have a checklist or memo that says, okay, every month you have to do this. Every quarter you have to do this. And it gives you it doesn't have to recite the precise language, but it can say, look over here. For example, in your loan agreement, you're probably going to have to tell them if you have major litigation or something. That'll be in your covenants, in your affirmative covenants. Your negative covenants will say, oh, I'm not going to have any casualty or condemnation. And if I do, I have to tell you about it. And then in your events of default list, this won't actually be in the covenants, but in the events of default, it'll be like, you can't have a change of control. And if you do, that's an event of default immediately. And so those are things you need to know about and be able to report to the lender. Kind of in concert with this, you need to talk to your internal team to make sure that they are communicating with each other. Because sometimes, especially if you have some sort of real estate involved, if you sign a new lease on that real estate, you have to get pre-approval from the lender to do that, right? And if you don't, you're in default. And so you can't have your property manager off signing leases and not telling usually the CFO's office about it, right? They have to communicate with each other to make sure that to the extent you need to get an approval from the lender or notify the lender, you do that. You don't want to be in a situation where the left hand doesn't know what the right hand's doing, and you find yourself in the situation where the bank is saying, okay, I've got an event of default here, and I'm willing to waive that for 50 grand, right? Because that often is what happens. If you're not in dire straits, you're not in bankruptcy land, but you have hit some sort of event of default, generally what lenders will do is they'll agree to waive the default or cure and allow you to cure it somehow. But they're usually going to demand some sort of payment as to do that. And so this is definitely one of those, spend a little bit of extra time and money right around the closing or shortly after the closing to get this put together to avoid your getting into hot water later on where you have to pay fees to get a default waived. Or if you're in the unfortunate situation where you have a loan-to-own lender, you're losing the asset. So on that happy note.
So I had a couple of thoughts just as I was listening to both of you that I would just want to go back and touch on briefly. Somebody may be saying, well, attorneys are expensive. Do I have to, pay for one to do the whole loan deal? And I think the answer is no. Obviously getting counsel involved is good. But I give you an example. LIBOR is being retired here, I believe, at the end of June. And for example, several weeks ago, we had a client approach the firm. They were doing a renewal, redoing a bid on a replacement there. And their big question was, is this proposed new interest rate, is this standard for the marketplace? It was a fair question. They didn't need us to, get into the whole nitty gritty weeds on that. And sometimes where you may be in a situation of, it's not all or nothing. You can have, hey, come in and give me some guidance. Are these terms standard? Is there something that you see here? That may be a way to try to save costs in certain situations. The other point.
I'm sorry, go ahead.
No, finish that and I'll give you my last point.
I was just going to say, yes, sometimes you will call on the attorney to help negotiate the term sheet or the letter of intent at the very beginning and help assist in getting the loan closed. But there really won't be much negotiation of the loan documents themselves. This particularly happens with banks, right? You negotiate the terms on the front end. The banks basically go, here are the loan documents. And then you're just trying to satisfy the conditions to fund the loan and close the loan. And there really isn't a lot of wiggle room to negotiate the documents themselves.
Yeah, right. The more standard regulated lenders, they have their Laser Pro docs, their form docs, and there's very little negotiation. I mean, you can tweak things here and there. It's only really when you get into the private companies that you can get really kind of freewheeling and free dealing on your terms and get really creative. But then obviously that's going to require more attorney work and be a little more expensive.
And the higher dollar the loan is, the more likely you are to have this kind of like bespoke loan agreement.
Yeah, absolutely. Very good point. Very good point. The other thing, it occurred to me when we talk about the relationships, I think it's important when you're applying for a loan that you try to figure out who the decision maker is going to be, because all loan officers, they will have lending authority up to a certain dollar amount, and they are the sole decision maker. But if it goes above that amount, it'll be different in different banks, but you get in different forms of loan committee. And I think when you're preparing to do for a loan renewal, even when you're shopping around, one of the big questions you want to kind of gently be finding out is who's actually going to be looking at this. Because if you're dealing with the frontline loan officer, he or she may be, oh yeah, things are great, right? But then it may go back to a loan committee who's maybe going to just scrutinize it a little bit more. They are just, they don't have any emotion or any relationship invested in it. They're just looking at the paper and the numbers. And that can actually, in close calls, that can actually make a big difference whether or not you're going to get the loan. So I think that's an important aspect when you're shopping around and figuring out, what do I need to do to, maximize my chance of getting a loan here? So, Brent, Tom, any other comments on that or anything else as we're really here at the end of the hour?
No, I'm good for me.
All right. Well, it doesn't look like we had any questions come in, but I think we've had a good discussion here today. So we just want to thank everybody for joining us here today. As a reminder, the program has been approved for legal education hours, and to report your hours, you'll click the CEU icon at the bottom of the screen. Tomorrow, you will get a certificate of attendance with the course number, along with that'll be emailed to you along with the recording of it. Again, we have the survey at the very end. You can see the contact information for Tom, Brent, and myself. If you have any individual questions, feel free to reach out individually or collectively, and we can chat with you about it. Again, the survey, please take a moment. We really appreciate any feedback that you may have. We look at this. It's really important to us because candidly, we're trying to bring value to you as the listener. So with that will conclude our webinar for today. Thank you very much.
Thank you.